This is Brad Wolff, and this is going to be the end of day Emini futures review for July the 29th, 2022. This will be posted on the Brooks Trading Course blog post for July the 29th. Coming into the day, well, first off, the market formed a spike and channel bull trend, as you can see labeled up here. It's also a trend from the open. You can call it the same thing. And the most important piece to notice is, first, the market entered by the close and formed a strong by the close rally. The problem the bulls had was it's climactic. Climactic here, small bars, another big bull bar, small bars, another big 2 or 3 consecutive bull bars, and sideways. That is not sustainable buying pressure. And when you start seeing buy climaxes, it starts to convince traders more and more to take profits and makes traders more hesitant to buy. They become worried that the market may reverse or have a deeper pullback than they want. So at this point, it is a strong breakout. Traders are buying closes and confident that you'll get a second leg. However, every new breakout, they become more and more worried because bears made money selling here. They might make money selling above this high, and it did not go above this high. And another thing to point out is you have the moving average here. Traders are happy to buy above the moving average when the market's strong, when it's clearly by the close. But the more climactic it becomes, the more sideways, which also means there's less momentum. And if there's less momentum, traders don't want to pay expensive. This is the fair price. If the market's far above the fair price, it becomes expensive. So traders want to buy a pullback. Most bulls would exit here. Aggressive bears would sell, betting on, you can call it a wedge, 1, 2, 3. You can call it a wedge, just output it, 1, 2, 3. And this is the breakout of the wedge. And then we got a couple legs up, forming a double top. So what Al is marking here is consecutive topping patterns. We had a wedge, we broke above the wedge, and we had a double top. Those bulls get out, bears will sell. And the bears will sell, betting on 2 legs down. This was a strong enough breakout. Traders will sell below here, confident that the market will have a second leg down. The bears know that this is probably not going to be a bear trend after this rally. Therefore, they're going to be willing to buy. They're going to be quick to buy back shorts. So they're buying, betting on a second leg. And even the bears selling here, they're selling, hoping that the market sells off further. But when it starts to stall, especially with it being a wedge, they're going to be quick to get out, which is what caused this bar. Now this is a 50% pullback. It went further than 50%, but it's still the same. It's still the same characteristics. 50%'s here. We broke a little below it, and we're probably going to go back to 50%. So it's trading range. Big up, big down. Consecutive bull bars. We're back to buy the close. Typically for buy the close, you need consecutive bull bars with at least 1, ideally 2, closing on their highs. And this was strong enough for a second leg. However, this is probably not going to be the second leg, and the first reversal down will fail. And the market rallied into the close. The biggest thing to notice here is right here, this blue text right here. Mini gaps and body gaps are strong. What that means is bears are unable to make money selling a new high. So the bears, they sold this high here, and we could not get back to the highs. So it's difficult for bears to make money, and if it's difficult for bears to make money, they may give up, which will drive the market up higher and higher. Another thing to point out is small pullback trend. And one of the other characteristics of a strong small pullback trend is there's not any climactic behavior. This is climactic, but it's not really climactic compared to all these bars. Climactic, but not much bigger than any of these bars. This bar is bigger, but it's not extraordinarily bigger. Look at this body compared to these. That's climactic. And the last thing to point out is wedges. Small pullback trends are constantly forming wedges. Wedge here, 1, 2, 3. Another wedge, 1, 2, and 3. Followed by another wedge, 1, 2, 3. And there's going to be nested wedges all in between. But the important piece is, if bears cannot make money selling above bars, bears are not going to make money selling below bars. That's what makes a small pullback bull trend dangerous to be selling. So overall on the day, this is a good day for the bulls. It's the third consecutive strong bull close on the daily chart, and that increases the odds that the market's going to get to the January 2nd low. 3 consecutive bull bars on the daily chart, you're probably going to get a second leg. So as far as, and you'll notice with what Alice marked on this chart, these are the reasonable stop entries. Traders will buy here. They would even buy here. They'll even buy here or this high. But the key is they're quick to be aware of what's going on. It's consecutive tops. You have a double top here. They'll be quick to exit. Bears selling here or even selling here, they understand the market's possibly forming a wedge, and it may go sideways. So they'll be quick to exit as well.